Today we're going to be covering Chapter 5 of the text dealing with relevant information for decision making with a focus on pricing decisions. As you can imagine, at some point in time, every organization has to decide, well, if it sells a product or a service, how much is it going to charge for that? And so what we want to do is to talk about that decision a little today. And so when we're done, what we should be able to discuss is to know the difference between relevant and irrelevant information for making pricing decisions. We want to be able to apply that decision process to business decisions. We want to talk about absorption and contribution margin income statements and identify their relevance for decision making. And we want to be able to decide to accept or reject special orders using this contribution margin approach. We also want to be able to explain why pricing decisions depend on the characteristics of the market, to identify factors that influence pricing decisions in practice, to compute a sales price by various methods and compare the advantages and disadvantages of these methods, and to use target costing to decide whether to add a new product. And so as we see here, relevant information depends on the decision being made, so it varies across decision frameworks. Decision making is choosing from among several courses of action. And so we want to use relevant information with regard to these several courses of action, right, in order to better inform our decision making abilities. Two criteria determine whether information is relevant. That is, the information must be an expected future cost, revenue, or cost, and it must have an element of difference among the alternatives. And so relevant information is the predicted future cost and revenue that will differ among alternatives. And so a decision model is any method used for making a choice. Right? Such models sometimes require elaborate quantitative procedures, such as a petroleum refinery's mathematical method for choosing what products to manufacture any given day of the week. A decision model, however, may also be simple. It may be confined to a single comparison of costs for choosing between two materials. In this example, our decision model is to compare the predicted unit cost, and assuming that everything else is equal, select the alternative with the lower cost. You'll be able to focus on relevant information, that is the predicted future differences between alternatives in any decisions. And so as we said, a decision model may be confined to a single comparison of costs for choosing between two materials, as in an example of tin versus aluminum cans. In this example, our decision model is to compare the predicted unit cost and, assuming everything else is equal, select the alternative with the lower cost. The decision process in Exhibit 5-1 applies to all business decisions, no matter how simple or complicated they may be. By using this process, you will be able to focus squarely on the relevant information, that is the predicted future cost between alternatives in any decision. In the best of all possible worlds, information for decision making would be perfectly relevant and accurate. And you can see that we can have the degree to which information is relevant or precise often depends on the degree to which is either qualitative, which is subjective, or quantitative, which is financial or numerical. So Cordell produces and sells 1 million units of seat covers for seats on airplanes, buses, and railway passenger cars. Cordell sells these to companies such as U.S. Airways or Grand Canyon Railway Company. The total manufacturing cost of making 1 million seat covers is $30 million. The unit manufacturing cost of the product is $30 million divided by 1 million units, or $30 per unit. We'll assume the Cordell Company has direct material cost of $14 million and direct labor cost of $6 million, or $20 million in direct material cost and direct labor cost. Here we see the Cordell Company's schedules of predicted indirect manufacturing costs for the year ended December 31, 20x1 in thousands of dollars. Here we see Cordell Company's schedules of predicted selling and administrative expenses for the same year. So these are selling, general, and administrative expenses, right, versus what we saw in our previous slide, which were indirect manufacturing costs for the same period. So where we talk about the absorption versus contribution approach, absorption costing considers all indirect manufacturing costs, variable and fixed, to be product or inventoriable costs that become an expense in the form of manufacturing cost of goods sold. Contribution costing is an internal or a management accounting reporting method that emphasizes the distinction between variable and fixed costs for the purpose of better decision making. If we look at the absorption approach for Cordell Company, we can see that their income statement using the absorption approach or absorption costing, the method used by most companies for external reporting. Firms take this approach, consider all direct and indirect manufacturing costs, variable and fixed, to be product cost or inventoriable costs that become an expense in the form of a manufacturing cost of goods sold only when the firm sells the product. Alternatively, if we look at the contribution margin approach, we see a different income statement for the year ended. So the absorption approach separates manufacturing costs from non-manufacturing costs, and it deducts the manufacturing costs from sales to compute a gross margin, and then deducts non-manufacturing costs to measure profit. The contribution approach separates the fixed costs from variable costs. It deducts the variable costs from sales to compute a contribution margin, and then deducts fixed costs to measure profit. And so before considering more general approaches to pricing, it's helpful to examine how a manager might approach a specific pricing decision, whether to accept a proposed price for a special sales order. Should Cordell sell the 100,000 seat covers for the purchase price or for the price of $26 a piece, right, versus the usual $30 per unit to manufacture the product. On the surface, it says, well, we shouldn't. It costs us $30. We can only sell them under this special order for 26,000 units, $26 per unit for the 1,000 units. So should we accept it or not? Accepting the special order would not affect Cordell's regular business. It would not raise any antitrust issues, would not affect total fixed costs, would not require additional variable selling and administrative expenses, and it would use some otherwise idle manufacturing capacity. And so with the sales order, we see that only the variable manufacturing costs are affected by this particular order at a rate of $24 per unit. Right? All other variable costs and all fixed costs are unaffected and thus irrelevant. And so the special order sales or unit price is $26, as we saw. We saw that the increase in the manufacturing cost per unit are $24, so we have an additional operating profit per unit of $2. Based on the preceding analysis, should we accept the order? Well, we're going to say yes to this because $2, right? The $2 additional operating profit per unit at 100,000 units equals $200,000 additional profit. Both the contribution margin and the operating income increased by $200,000, so we could ignore the fixed cost and come to the same conclusion. However, management may prefer to see the effect of its decision on operating income, so we include the irrelevant fixed cost in the presentation. Note that our conclusion is that short-term or short-run income will increase by $200,000. In this example, we assume that this special order would neither affect Cordell's regular business nor cause any additional fixed costs. Remember all the assumptions we stated earlier. These assumptions may be appropriate in the short run, but they may not hold in the long run. Accepting the special order may eventually affect sales to other customers, and it may at some time entail additional fixed costs for expanded capacity. If there are any other expected long-run differences between accepting versus not accepting the special order, these differences should also be incorporated in the analysis. And so here we see an incorrect analysis or a misuse of unit cost. Faulty cost analysis can occur by misinterpreting unit fixed costs, especially with an absorption approach. For instance, Cordell's managers might erroneously use the $30 at unit manufacturing cost under the absorption approach, which would say then, no, don't accept it if it's going to cost $30 to manufacture each unit versus the $26 sales price, then we would say no under that approach, but that's faulty for the reasons indicated here. The incorrect prediction of a $3 million increase in cost results from multiplying 100,000 units by $30. The fallacy in this approach is that it treats a fixed cost, the fixed manufacturing cost, as if it were variable. Avoid the mistake of using total unit cost as a basis for predicting how total costs will behave. Unit costs are useful for predicting variable costs, but can be misleading when used to predict fixed costs. So the typical cost accounting system serves two purposes simultaneously. One, planning and control, and two, product costing. The total fixed cost for planning and control purposes can be graphed as a lump sum. And so Cordell examined its $24 million of variable manufacturing costs and discovered two significant activities and related cost drivers. $21 million of processing activities that varies directly with units produced, that is $14 million of direct material plus $6 million worth of direct labor and $1 million of variable manufacturing overhead, at a rate of $21 per unit, and $3 million of setup activity that varies with the number of production setups. For product costing purposes, however, it's easy to misinterpret the fixed unit manufacturing cost to act as if fixed costs behave as if they are variable costs, which is contrary to fixed cost behavior. So now suppose the special order is for 100,000 units that can only vary slightly in production specifications. Instead of the normal 50 setups, Cordell will need only 5 setups. So processing 100,000 units will only take $2.13 million of additional variable manufacturing cost. One of the major decisions managers face is pricing. Actually, pricing can take many forms. In addition to pricing special orders, managers make the following pricing decisions. So they could be setting the price of a new product or a refined product, setting the price of products sold under private labels, or responding to a new price of a competitor, and finally producing or pricing bids in both sealed and open bidding situations. Pricing decisions depend on the market characteristics in which a firm operates. In perfect competition, all competing firms sell the same type of product at the same price. Thus, a firm can sell as much of the product as it can produce at all at a single market price. If it charges more, no customer will buy. If it charges less, it sacrifices profits. Therefore, every firm in a market will charge the market price, and the only decision for managers is how much to produce. The marginal cost is the additional cost resulting from producing and selling one additional unit. The marginal revenue is the additional revenue resulting from the sale of an additional unit. In imperfect competition, the price a firm charges for a unit influences the quantity of units it sells. At some point, the firm must reduce prices to generate additional sales. To sell additional units, the firm must reduce the price of all units sold. Therefore, the marginal revenue curve is below the demand curve. To estimate marginal revenue, managers must predict the price elasticity, that is, the effect of price changes on sales volume. Remember, price elasticity is the effect of price changes on sales volume. Accountants seldom compute marginal revenue and marginal cost curves. Instead, they use estimates based on judgment to predict the effect of additional production and sales on profits. In addition, they examine selected volumes, not the whole range of possible volumes. Such simplifications are justified because the cost of a more sophisticated analysis would exceed the benefits. And so managers must consider constraints imposed by the United States and international laws when making pricing decisions. These laws often protect customers or consumers, but they also protect competing companies from predatory and discriminatory pricing. Predatory pricing means setting prices so low that they drive competitors out of the market. The predatory pricer then has no significant competition and can raise prices dramatically. Discriminatory pricing is charging different prices to different customers for the same product or service. Most companies gather information regarding a rival's capacity, technology, and operating policies. In this way, managers make more informed predictions of competitors' reactions to a company's prices. The study of game theory focuses on predicting and reacting to competitors' actions. A manager's expectations of competitors' reactions and of the overall effects of price changes on an industry's demand heavily influence pricing policies. For example, an airline might cut prices even if it expects matching price cuts from its rivals, hoping that total customer demand for the tickets of all airlines will increase sufficiently to offset the reduction in the price per ticket. Competition is becoming increasingly global in its scope. Overall capacity in some countries often causes aggressive pricing policies for a company's exported goods. For example, as companies might dump products by selling them at a lower price in a foreign market that is isolated from its other markets. As you can imagine, when companies' markets expand globally, their pricing policies become more complex. More than ever before, managers are recognizing the needs of customers. Pricing is no exception. If customers believe a price is too high, they may turn to other sources for the product, substitute a different product, or decide to produce the items themselves. Most managers examine the relationships of cost to selling prices to set formulas for pricing. 4 popular markup formulas for pricing are as a percentage of variable manufacturing cost, as a percentage of total variable cost, as a percentage of full cost, or as a percentage of total manufacturing cost. What this means is that companies may turn to one of these alternatives to simply mark up to a pricing amount, as a percentage of one of these: variable manufacturing, total variable, full cost, or total manufacturing cost. Setting prices by computing an average cost and adding a markup that is, the total amount by which sales price exceeds cost. Target prices can be based on a host of different markups that are in turn based on a host of different definitions of cost. The advantages of contribution approach in cost plus pricing is that prices based on variable costs represent a contribution approach to pricing. When used intelligently, the contribution approach has some advantages over total manufacturing cost and full cost approaches because the latter two often fail to highlight different cost behavior patterns. As a result, this approach allows managers to prepare price schedules at different volume levels. Target pricing with full costing presumes a given volume level. In the long run, a firm must recover all costs to stay in business. Sooner or later, fixed costs do indeed fluctuate as volume changes. Therefore, it's prudent to assume that all costs are variable, even if some are fixed in the short run. Computing prices based on absorption cost may indicate what competitors might charge, especially if they have approximately the same level of efficiency as you and also aim to recover all costs in the long run. Absorption cost formula pricing meets the cost-benefit test. It is too expensive to conduct individual cost-volume tests for the many products, sometimes thousands, that a company offers. And there is much uncertainty about the shape of the demand curves and the correct price output decisions. Absorption cost pricing copes with this uncertainty by not encouraging managers to take too much marginal business. Advantages also include absorption cost pricing tends to promote price stability. Managers prefer price stability primarily because it makes planning more dependable. Absorption cost pricing provides the most defensible argument for justifying prices to all interested parties, including the government antitrust regulations. And then finally, absorption cost pricing provides convenient reference points to simplify hundreds or thousands of pricing decisions. Another approach to the relationship between cost and prices is to take a product's market price as given and determine the maximum cost the company can spend to make the product and still achieve the desired profitability. We call this target costing. Value engineering is a cost reduction technique used primarily during the design stage that uses information about all value chain functions to satisfy customer needs while reducing costs. And finally, Kaizen pricing is a Japanese term for a continuous improvement during manufacturing. Some companies understand the market in which they operate and use the most appropriate pricing approach. And so this concludes chapter 5. And again, I encourage you, please go back and read the chapter closely. We talked about a lot of different topics and theory in this chapter. And then once you're comfortable with that, please continue on through the discussion forum and to the learning exercises. Thank you. We'll see you in chapter 6.